Your mortgage is probably one of the largest debts you will ever carry. And for most people, it comes with a 30-year repayment timeline that can feel like it stretches into the distant future. But here's something that a lot of homeowners do not realize. You don't have to follow that timeline. There are several straightforward strategies that can shave years, even decades off your mortgage and save you tens of thousands of dollars in interest along the way. My name is Robert Portal and I'm a home loan advisor. My team and I have helped hundreds of families across the nation navigate the home buying process while making it stress-free. In this video, I'm walking you through the most effective ways to pay off your mortgage faster. Some of them cost you very little extra each month. Others are bigger moves that require some planning. All of them are worth understanding so you can choose what works best in your situation. Let's get into it. Why paying off your mortgage faster matters. Before we get into the strategies, let's talk about why it's worth thinking about it at all. When you take out a 30-year mortgage, the way that your payments are structured means that you pay a tremendous amount of interest over the life of the loan. Let's look at a real example. On a $400,000 loan at 7%, your monthly principal and interest payments is about $2,661. Over 30 years, you'll make payments totaling roughly $958,000. That means you pay nearly $558,000 in interest alone on top of the $400,000 you originally borrowed. That's not a typo. You pay more in interest than you borrowed. Now, that doesn't mean necessarily that a 30-year mortgage is a bad choice. The lower monthly payments give you flexibility and cash flow that can be directed towards other financial goals. But it does mean that every extra dollar you put towards your principal early in the loan has an outsized impact. Because of how mortgage amortization works, paying down principal in the early years eliminates future interest that would have compounded over decades. Understanding that concept is the foundation for everything we're going to cover today. Strategy 1, making one extra payment per year. This is the simplest strategy on the list and one of the most cost-effective relative to how little it costs you. If you make just one additional full mortgage payment per year applied entirely to principal, you can cut several years of a 30-year loan. On our $400,000 example at 7%, making one extra payment per year reduces your loan term by approximately 4 to 5 years and saves you tens of thousands of dollars in interest. Now, how do you make this work practically? A few ways. The easiest is to divide your monthly payment by 12 and add that amount to each regular payment as extra principal. So instead of paying $2,661, you pay about $2,883 every month. Over the course of the year, those extra increments add up to one full extra payment, but it's spread out in a way that's barely noticeable month after month. Another option is to make a lump sum extra payment once a year, using a tax refund, a bonus, or any other windfall that comes your way. The critical thing is to make sure your lender applies the extra amount to principal, not to future payments. When you submit that extra money, write apply to principal on the check or select that option in your online payment portal. If the extra money gets applied to future payments instead, it doesn't reduce your interest the same way. Strategy 2, switch to biweekly payments. This strategy is elegant in its simplicity. Instead of making one monthly payment, you make half a payment every 2 weeks. Here's the math that makes it work. There are 52 weeks in a year. If you pay every 2 weeks, you make 26 half payments, which equals 13 full payments per year instead of 12. That extra payment per year goes entirely to principal and can cut 4 to 5 years of a 30-year mortgage without you ever feeling like you made an extra payment. Many mortgage servicers offer a biweekly payment program you can enroll in directly. Some charge a small setup fee, so I would ask about it. Alternatively, you can achieve the same effect by making your own extra principal payment each year rather than formalizing it through a biweekly program. One important note, make sure your mortgage has no prepayment penalty before you start making extra payments. Most modern loans don't, but it's always worth confirming with your servicer before you begin. Strategy 3, round up your payment. This one is almost painless and requires zero discipline once you set it up. If your monthly payment is $2,661, simply round it up to $2,700 or $2,750 or $3,000. Whatever amount you feel comfortable, and apply the difference to principal every month. It sounds almost too simple to matter, but the math tells a different story. Running up your $2,661 payment to $2,750 means you're paying an extra $89 per month towards principal. Over the course of a year, that's more than $1,000 in additional principal reduction over several years, and compounded by the interest those dollars would have generated, the savings add up significantly. The key is to set it up as your automatic payment amount so it happens without you having to think about it every month. Make the decision once and let it run. Strategy 4, applied windfall directly to principal. Tax refunds, work bonuses, gifts, inheritance, side income, anytime money comes into your life unexpectedly or above your normal budget, consider directing a portion of it straight to your mortgage principal. A single $3,000 lump sum payment applied to principal in the early years of a 30-year mortgage can eliminate thousands of dollars in future interest payments and shave months off of your loan term. You don't have to put every windfall toward your mortgage. Balance is important, and we'll talk about that later. But making it a habit to direct a meaningful portion of unexpected income toward principal is one of the most powerful things you can do for your long-term financial picture. Quick pause. If you're learning things today that nobody explained to you when you got your mortgage, then this channel is built for you. We post new videos every week breaking down homeownership and mortgage topics in plain English. So hit that subscribe button so you don't miss a thing. All right, let's get back into it. Strategy 5, refinance to a shorter loan term. If you currently have a 30-year mortgage and you have the financial flexibility to handle a higher monthly payment, refinancing to a 15-year mortgage is one of the most powerful ways to accelerate your payoff timeline. Here's what changes when you go from 30 years to 15. First, you pay off the home in half the time. You typically get a lower interest rate. Now, 15-year loans almost always carry a lower rate than 30-year loans. And a combination of a shorter term and lower rate means you pay dramatically less interest over the life of the loan. Now, let's look at some numbers. On a $400,000 home at 7% on a 30-year term, you pay roughly $558,000 in interest. On a 15-year term, let's say at 6.25, you'd pay approximately $212,000 in interest. That's a difference of over $340,000. The trade-off is that your monthly payment goes up significantly, from about $2,661 to roughly $3,400 in this example. That's nearly $800 more per month. For some homeowners, that's a comfortable stretch. For others, it's too much pressure on the monthly budget. A refinance also comes with closing costs, typically 2 to 5% of the loan amount. So you want to run a break-even point or analysis to make sure the long-term savings outweigh the upfront costs. Strategy 6, mortgage recasting. This is a strategy most homeowners have never even heard of, and it's a hidden gem for people who come into large sum of money. Mortgage recasting, also called reamortization, is when you make a large lump sum payment towards your principal and then ask your lender to recalculate your monthly payment based on the new lower balance. Your interest rate and long term stay the same, but your monthly payment drops because you owe less. Now, here's why this is different from just making an extra payment. If you simply pay $50,000 extra towards principal without recasting, your required monthly payment doesn't change. You just pay off the loan faster. With recasting, your lender recalculates the payment and you actually get a lower required monthly payment going forward. This can be particularly useful if you receive an inheritance, sell another property, or come into a large sum and you'd rather lower your monthly obligations than accelerate your payoff timeline. Now, not all lenders offer recasting, and those that do typically charge a small fee, usually $150 to $500. You also generally need to make a minimum lump sum payment, often $5,000 to $10,000 or more, depending on the lender. It's worth calling your servicer to ask whether this is an option. Strategy 7, pay off higher interest debt first, then redirect. This last strategy is a little different. It's about sequencing your financial priorities correctly before you pour extra money into your mortgage. Mortgage debt is typically the lowest interest debt most people carry. Credit cards, personal loans, car loans, and student loans often carry significantly higher interest rates. If you're paying 20% on a credit card balance while making extra payments on a 7% mortgage, you're losing money on the math. The financially optimal approach is to pay off your higher interest debt first, aggressively, and then redirect those freed up payments towards your mortgage once a high rate debt is gone. For example, if you pay off a car loan with a $500 monthly payment, redirect that $500 entirely to your mortgage principal the moment the car is paid off. You were already living without that $500 anyways, you won't miss it. And apply it to your mortgage, it becomes one of the most powerful extra payment streams you can create. This strategy requires patience and sequencing, but it's often the highest return move available to most homeowners. Now, an important consideration: should you always pay off faster? Before we wrap up, it's worth asking an honest question. Is paying off your mortgage faster always the right move? Not necessarily. Mortgage interest may be tax deductible depending on your situation. Speak to a tax professional about how this applies to you. Some homeowners find that directing extra money towards a diversified investment portfolio produces a higher long-term return than the interest saved on a relatively low-rate mortgage. Maintaining liquidity, having accessible cash savings also has real value, especially in the early years of homeownership. The right answer depends on your interest rate, your other financial goals, your tax situation, and your personal comfort level with debt. What's important is that you make the choice intentionally, not by default. Recap and next steps. Let's bring it all together. Here are 7 strategies to pay off your mortgage faster. 1. Make one extra full payment per year applied entirely to principal. Spread it across months or make it as a lump sum. 2. Switch to biweekly payments. 26 half payments per year equals 13 full payments instead of 12. 3. Round up your payment. Even a small amount applied consistently adds up significantly over time. 4. Apply windfalls, tax refunds, bonuses, and unexpected income directly to principal. 5. Refinance to a shorter term loan. A 15-year mortgage can save hundreds of thousands of dollars in interest. 6. Ask your lender about mortgage recasting, a large lump sum payment that lowers your required monthly payments going forward. 7. Pay off higher interest debt first, then redirect those freed up payments to your mortgage. Not every strategy is right for every homeowner, but understanding all of them puts you in control of one of the most important financial decisions of your life. Even implementing just 1 or 2 of these consistently can have a dramatic impact over the life of your loan. So drop a comment below. Are you currently using any of these strategies, or is this the first time you thought about paying off your mortgage early? I'd love to hear where you are in your journey. And if you haven't subscribed yet, we post videos every single week helping first-time buyers and homeowners build real financial confidence. See you in the next one.